Welcome to Advanced Asset Management Advisors' third quarter 2024 market commentary review. I'm Bob Baker, president of Advanced Asset Management Advisors, and joining me today is Phil Volker, my business partner and AAMA's chief investment officer. Before we talk about the markets and the economy, let me briefly talk about AAMA. AAMA is located in Columbus, Ohio, and we have approximately 937 million of assets under management and advisement. AAMA is a fundamental investment advisor in terms of our discipline, and we believe our discipline is easy to understand, track, and discuss. Our investment team is highly experienced, with an average of 30 years of experience per person. In addition, we're accessible. If you have any questions about our portfolios, the markets, or the economy, we're happy to discuss those with you if you'd like to do so. Now let's jump into the market during the third quarter. During the third quarter, the S&P 500 basically had a series of 3 advances and 3 declines for the quarter. The first decline was over 8.5%. That happened in 14 days, but then the market took 14 days and recovered from that. It also experienced a 4.2% decline in 4 days, and it recovered fully in 7 days. So for the whole quarter, the S&P 500 was up 5.9%. And we label that as a hyperactive quarter. Now, Phil, would you like to talk about consumer confidence?
Sure, Bob. As background, everybody knows that there's been a lot of prognostications over the last 3 years for a recession. It hasn't happened yet. We've been steadfastly more constructive on the economy and have not expected a recession, even though a lot of these indicators have been foolproof in the past. But we've started to open the window for potential weakness developing in the economy sometime next year. And a couple reasons. One, we are not seeing the consumer sentiment holding up real well. The general index is down, present situation, and expectations as well. Part of that could be related to the fact that consumer prices are up 21% in the last 4 years. They're not going down. We talk about a lower inflation rate, but that's just a slower rate of increase. And a 21% increase in the cost of living tends to weigh on the economy eventually. And the housing market's still locked down, with a lot of people being locked into low interest rates. That's great, but we just are not seeing the transactions in the housing market. So, looking back over the last several years, higher interest rates, higher prices eventually tend to weigh on the economy.
And would you like to talk a couple minutes about monetary policy and the double-edged sword of that?
Sure. We've talked about how the Fed had built a balance sheet of $9 trillion over the last 15 years, from under $1 trillion 15 years ago. So there's still a lot of liquidity in the system. The Fed has reduced its balance sheet by 22%. It's now $7 trillion, but still significantly higher than what it had been years ago. So the Fed has been struggling with how to remove liquidity without causing a recession. And, the soft landing that everybody talks about, or however you want to call it, it's like threading a needle. And they also, are trying to keep the labor market together. And they don't want to upset the trend towards lower inflation. So they're in a balancing act. It's an unprecedented situation because the Fed's balance sheet has never been this large. And our contention is that with 12 years of balance sheet growth from 1 to 9 trillion, you're not going to fix that overnight, or probably not even in 3 years. It's going to take 5 to 6 years to get that fixed. So the Fed is navigating a very narrow path to keep things in balance.
Now that brings us to inflation that you mentioned a couple minutes ago.
Sure. The way we track inflation is we annualize the monthly inflation rate, and then we run a 6-month moving average. The 6-month moving average right now is 2.7, which is the same place it was roughly 9 months ago. And this is the Fed's favorite inflation measurement, which is core services of the PCE ex energy and housing. We would like to see further improvement in the 6-month moving average before we say the job is complete, because these numbers do jump around month to month. And we suspect that the Fed probably looks at a number like this as well. So, we're back where we were 9 months ago, but we're not at a level yet to say the job's over with. One of the big factors in this number is housing, and rents are incorporated into this number on a lagging basis. Rents had been falling for a while, which helped bring this down. But more recently, rents have been increasing, and that's going to be a headwind for this core PCE going forward, starting here in the next couple months. So a lot of moving parts, but the Fed's job is not done, in our opinion.
And of course, this leads us to talk about equity expectations and valuations today.
Yeah, the Fed, as everybody knows, and everybody knew ahead of time, several weeks ahead, because Chairman Powell announced at Jackson Hole that it was time to start reducing interest rates. And they did at their September meeting. They cut by 50 basis points, which was cheered by the markets, at least initially. And a lot of the financial media started citing statistics about every time the Fed has cut rates, the market has gone up X percent over 6 months or 12 months, or whatever measurement they chose. But if you look at the detail of those measurements, there's a key factor that helps determine what those results are that get wrapped up into that average experience. So, for example, 1982, stocks were trading at 7.5 times trailing earnings, a depressed number. And so when the Fed started cutting rates in 1982, stock performance was turbocharged because stocks were starting from a very, very low valuation. In 2007, stocks were trading at 17.5 times trailing earnings, and the Fed cut rates aggressively. We all know what happened. The Fed rate cuts didn't do anything on the margin to help stem the major bear market that was coming. So you compare that with today, and stocks are trading at 25 times trailing earnings. And so our suggestion is that it's unrealistic to apply the historical results after rate cuts to today's markets. Starting point being 25 versus 7.5 or even 17, it's just unreasonable to expect the market to react like it has in the past on average, or in some of the extremes.
Now let's focus on some of the earnings outlook. Can you add some color to this?
Sure. S&P 500 earnings went through a little earnings depression starting in the first quarter of 23. These gray bars indicate how much quarterly earnings were falling below the high water mark, if you would. So first quarter of 23, for example, earnings were 7% below that high water mark. And through the first quarter of this year, they ranged from -4 to that -7.5% below that high water mark. The second quarter of this year, the last gray bar, shows that earnings finally exceeded the peak that they posted back in 2022 by about 3%. This quarter, expectations for earnings that are soon to be announced is that earnings will exceed that high water mark by 7%. And then earnings estimates going forward, 12, as much as 25% higher by the end of next year than what they were back in 2022. Now, these numbers, earnings estimates, forward looking earnings estimates are always optimistic. They almost always get revised lower, but the market's betting on some big things developing in earnings. And, profit margins that are pretty high level right now. So there's going to have to be some pretty dramatic growth in the economy, growth in sales, and some margin, even further margin expansion for these numbers to be met. Time will tell, as always, with earnings, but we think these are a little bit optimistic.
Now let's take a couple minutes and talk about market volatility. And you put together a really neat chart going back 33 months.
Yeah, this is basically starting from the first of the year when the Fed started to raise interest rates in March 22. And the green line at the top is return of 90-day Treasury bills. And the blue line at the bottom is long-term Treasury bonds. And the interesting thing is that Treasury bills always provide a smooth ride with no volatility. But in the last couple years, with interest rates being higher, T-bills trading at 5% or higher, that line, if you use it as a target, has been increasing more rapidly than it had been for years. So, if you just look at the average large cap stock, unweighted S&P 500, it declined significantly, 20% or so, and had a lot of volatility through 23, and has just now, in this last month, really caught up with where Treasury bill returns are posted for September 30. Small cap stocks have caught up to where they started this period, so they're not caught up with Treasury bills at this point. And that's the average small cap 600. So it's been a volatile ride for close to 3 years, with T-bills providing a pretty smooth ride and stocks now having caught up.
Now, could you cover our current positioning within the portfolios?
Sure, and this is going to be sounding like a broken record to everybody, but in the equity portfolios, we continue to be focused on large cap stocks. We have a definite tilt towards more defensive sectors, healthcare, utilities in particular. But through all of the holdings, there's an emphasis on earnings stability and balance sheet quality. We think it's, with the rising interest rate trend that we've been in, it's important to have strong balance sheet. And on the fixed income side, again, broken record, we're short maturities and high quality. There was a bond market rally from last October through just recently, where rates came down, longer term rates came down. But we think that's a little bit overdone. We think the inflation rate is probably going to settle in between 2.5% and 3%. And you put a couple percent on top of that for a real return, and the 375 10-year Treasury just doesn't get it. And we're starting to see, the day of the Fed rate cut was actually the low in 10-year rates, and they've risen since then. And in particular, today with the strong employment report, they're up another 10, 15 basis points. So again, risk in the longer term bond market is keeping us in a shorter maturity portfolio.
Phil, thanks so much for going through all the detail today from our market commentary. If any of our audience has any questions or would like to discuss the markets in greater detail, you can give us a call. As I mentioned earlier, our team is accessible, and we're most happy to answer any questions you might have. So until next quarter, thanks for joining us.